Welcome back to the Pro Ticker Podcast, your Wednesday morning edition covering major financial magazine headlines, everyone.
Good morning.
You, our listener, have brought us a fascinating collection of articles today. As we started digging into these, a central theme really seems to be jumping out.
Oh, yeah. What's that?
It looks like this intricate dance between, cutting-edge technology and the increasingly complex global landscape. Trade, geopolitics, it's all tangled up.
Absolutely. You've curated a set of reports that really highlight this tension. We're seeing it play out big time in the semiconductor industry, for instance.
And those ripples are spreading through global markets, influencing trade relationships.
Exactly. It's going to be a compelling exploration today. Our mission really is to unpack these stories, connect those dots for you, our listeners, and pull out the insights that truly matter.
Okay, let's dive in then. Starting with semiconductors, which seem to be, really feeling the heat right now. MarketWatch brought us a report titled ASML, a key microchip bellwether, disappoints on orders. Now, ASML, for those maybe less familiar, they're a crucial Dutch company, huge in chip-making equipment.
Right. Absolutely essential. And this MarketWatch piece highlights their first quarter net bookings were lower than expected, came in around, $3.9 billion?
Yeah, against expectations closer to $4.8 billion.
Yeah.
That's a pretty steep drop from the previous quarter's $7 billion plus.
It is. But what's particularly interesting, as MarketWatch points out, is that while these future orders were down, their current numbers net income, sales, they actually held up pretty well.
So close to what analysts predicted for Q1 itself.
Pretty much, yeah. They're still selling a lot of those incredibly advanced lithography machines. But this dip in bookings, that suggests a potential cooling off down the line. Creates some uncertainty,
Makes sense. And their forecast for Q2 sales was also just a touch below what analysts were hoping for.
Right. And the shadow of tariffs seems to be looming large here.
ASML themselves mentioned it, didn't they? Growing uncertainty because of recent U.S. tariff talk.
They did. Their CFO even got specific, according to the article, explaining how tariffs could hit different parts of their business. Not just the machines they ship, but also spare parts needed out in the field.
And even their own manufacturing here in the U.S.
Yep, it touches everything. And connecting this to the bigger picture, ASML's CEO, Christophe Fouquet, noted that AI is still a massive growth driver.
But it's complex.
Exactly. Creates both upside and downside risk. So the demand for those high-end chips that ASML's gear makes is still strong, fueled by AI. But these other headwinds, macroeconomic stuff, trade tensions, they're making the path forward harder to predict.
Which leads us perfectly into NVIDIA, another semiconductor giant. Both MarketWatch and Bloomberg reported on this. NVIDIA expects to record huge charges, potentially up to $5.5 billion in its first quarter.
And that's a direct hit from the updated U.S. export rules targeting their H20 chips, the ones meant for China.
What's really striking here, and MarketWatch highlighted this, is that the H20 chip was specifically designed by NVIDIA to meet the previous U.S. government concerns about tech exports to China.
Exactly. It was meant to be the compliant chip. So this new ban, well, it really feels like a significant step up, a real escalation.
And analysts quoted in MarketWatch think this could basically hand the Chinese AI market over to domestic companies like Huawei.
That's the concern, yeah. It raises some profound questions about the long-term competition for NVIDIA and, the whole tech rivalry between the U.S. and China.
And that $5.5 billion charge, that's not small change. It's the value of unsold H20 chips plus writing off customer orders.
Huge impact. And Bloomberg also covered the wider market reaction. Tech stocks took a big hit after the NVIDIA news and the ASML orders report.
How big a hit are we talking?
Bloomberg mentioned a staggering $155 billion in market value vanishing from just those two companies, ASML and NVIDIA, alone.
Wow, okay. That really underscores how interconnected this whole global tech supply chain is.
Absolutely. And Bloomberg's analysis suggests this U.S. ban on the H20 isn't seen as just a temporary spat. It's being read as a more permanent strategic move.
Driven by ongoing worries about China's rapid progress in electronics.
Seems that way. So this isn't just a minor trade issue. It looks like a deliberate policy with potentially long-lasting effects on the whole semiconductor world and China's tech ambitions.
So for our listeners, this could mean we're seeing a potential reshaping of the global tech map happening right now.
Could be. And as Bloomberg notes, even though the H20 was already a scaled-down chip, these new restrictions raise serious questions about China's future access to critical global tech hardware.
And it's not just China directly, right?
Sure.
Other Asian tech firms relying on these chips might also be hurting.
That's a definite possibility. And while China is pushing hard for technological self-reliance, we know they still have a ways to go to truly catch up with the global leaders in certain areas.
Okay, this sets the stage nicely for our next topic, China's broader economy and the fallout from this intensifying trade situation.
Right. The Wall Street Journal had a piece, China's economy grew before tariffs kicked in. It pointed to 5.4% growth in the first quarter.
Which sounds pretty good on the surface.
It does, but the key phrase there is before tariffs kicked in. As the WSJ piece explains, a lot of that growth was driven by a surge in exports ahead of these new U.S. tariffs taking effect.
So the crucial takeaway from the journal is that this growth probably won't last. It's expected to slow down significantly as the trade war bites harder.
That's the widespread expectation, yes. The big question mark is how well China can pivot. Can they find new export markets quickly enough? Can they boost domestic spending enough to make up the difference?
And the WSJ mentioned some economists are forecasting growth could drop pretty low, maybe 4% or even less this year.
Yeah, which, if it happened, would be the slowest growth China's seen in decades if you exclude the pandemic years. It's a serious potential slowdown.
And the U.S. strategy, as laid out in the article, seems quite deliberate. Use tariff talks to pressure other countries to limit their dealings with China.
That appears to be the goal, yes. Trying to sort of isolate China's economy further.
But we need to remember, this isn't just a one-way street. The Wall Street Journal also mentioned the U.S. itself faces risks from these tariffs, right? A potential slowdown here, too.
Absolutely. Some economists are even flagging concerns about a possible recession in the U.S. if higher prices from tariffs start to really pinch consumers, and if the general uncertainty hits business investment.
Are we seeing actual signs of trade cooling off yet?
The WSJ says yes. They report container traffic at major Chinese ports is down, and the cost of shipping goods to the U.S. West Coast has dropped noticeably. That points to weakening demand.
Interesting. Even though retail sales inside China showed a bit of an uptick.
Right, so government efforts to boost domestic consumption might be having some effect, but the overall consensus among economists, according to the journal, is that forecasts for Chinese export growth are being revised downwards because of the trade war.
So for anyone listening involved in supply chains, these are definitely critical shifts to watch.
No doubt about it.
And here's a very specific example of these trade tensions hitting an industry. Bloomberg reported that China is effectively banning Boeing jets.
As direct retaliation for U.S. tariffs, yeah, that's a big move.
Creates huge challenges for Chinese airlines, right? Many rely heavily on Boeing planes.
It really does. As Bloomberg points out, it forces China to scramble for alternatives. They need new planes, they need parts to keep their existing Boeing fleets flying, but Airbus can't just instantly ramp up production.
And China's own jet maker, Comac, still depends on U.S.-made engines for its C919 time.
Exactly. So Bloomberg details how Chinese airlines and leasing firms have been kind of stockpiling spare parts, and Comac has been gathering engines, short-term fixes, really.
There was also that interesting potential workaround mentioned by Bloomberg, China asking Airbus to maybe supply new planes with extra engines, even if those engines have U.S. parts.
Yeah, that really highlights how tangled up the global aerospace industry is. Even when you're retaliating, you might still need technology from the other side. It's complex.
So the Boeing situation, as Bloomberg emphasizes, really puts a spotlight on China's dependence on U.S. and Western aerospace tech, a key vulnerability.
Definitely. And some analysts mention in the article even wonder if this delivery pause is partly a negotiating tactic in the bigger trade dispute.
Okay, let's shift gears a bit over to the energy sector. Bloomberg had an interesting report on Liberty Energy, Inc.
Ah, yes. The company formerly led by the current U.S. Energy Secretary, Chris Wright.
That's the one. Their stock has taken a beating this year, down something like 43%. What does that tell us about the U.S. oil patch?
Well, Bloomberg explains that oil field service companies like Liberty are often seen as sort of canaries in the coal mine for the broader industry.
Because they're hired for the new drilling and fracking.
Exactly. So if their stock tanks, it can signal that oil producers are getting cautious, maybe pulling back on new projects. And with lower oil prices, partly due to trade war impacts on demand, partly OPEC moves of S, it makes sense that U.S. shale producers might reduce drilling.
So if spending on oil services is dropping, as Liberty's stock price might suggest, did that mean U.S. oil production could actually stall or even fall this year?
That's the implication, according to Bloomberg. It would be a noticeable shift. Liberty's upcoming earnings report will be really closely watched for more clues on these trends.
So for listeners tracking energy markets, this is potentially a key turning point for U.S. production.
It could be. Though it's worth adding, as Bloomberg also notes, these service companies are generally in better financial shape than they were during past downturns.
So maybe less risk of a widespread financial crisis within the service sector itself.
Probably less risk, yeah. More of a slowdown in activity is the main concern right now.
Okay, let's move into finance and regulation. The Wall Street Journal had an exclusive on a cyber attack hitting the Office of the Comptroller of the Currency, the OCC.
Right, a major U.S. bank regulator. And this news seems to have caused some real alarm among the big banks.
How so?
Well, according to the WSJ, big names like JP Morgan, Bank of America, BNY Mellon, they've actually reduced some of their electronic info sharing with the OCC since this hack was disclosed.
Really? Why?
The report says banks are worried about the security implications of the email hack itself, and also apparently felt the OCC's communication and response were, well, lacking.
That sounds serious. A breakdown of trust between banks and their regulator.
It certainly raises questions. This cyber attack on a key regulator, especially when you remember past talk about potentially changing these regulatory bodies, it makes you wonder, are the system's gatekeepers secure enough in today's world?
That's a critical question. And the journal says banks are now actively looking for more secure ways to send sensitive info to the OCC.
Seems so. And what's maybe most concerning is the timing the WSJ laid out. The OCC apparently posted a notice about the hack way back in February, but didn't proactively tell the banks directly.
So some banks found out from the media. Ouch. That definitely doesn't help build confidence or transparency.
No, it doesn't. It undeniably highlights worries about the cybersecurity readiness of regulatory agencies themselves, given the incredibly sensitive data they handle every day.
Okay, sticking with finance, but shifting focus. MarketWatch reported JP Morgan's CEO, Jamie Dimon, sold a big chunk of his company's stock recently.
Yeah, around $32 million worth, roughly.
What's the story behind that? Should people be worried?
Well, MarketWatch clarifies its important context. This sale was part of a pre-disclosed trading plan. Mr. Dimon filed it with regulators back in February.
Ah, okay. One of those 10b5-1 plans.
Exactly. They're pretty common for corporate insiders. You basically set up the sales in advance, specific times, specific prices or amounts. It helps avoid any suggestion you're trading on inside information you might have later on.
Right, because the decision to sell was made months ago, before any recent non-public news. It's like setting up automatic sales.
Precisely. So while the dollar amount catches the eye, it seems like a planned financial move. And MarketWatch notes it's only a small fraction of his total holdings in JP Morgan.
And it happened after the bank reported strong Q1 earnings, too.
Correct.
Now, for something a bit different, the Wall Street Journal had this fascinating piece about an options trader known as Captain Condor.
Ah, yes, David Cho. And the online trading community he leads.
Apparently, this group's collective trading can actually influence the S&P 500's volatility. That sounds wild.
It is pretty remarkable. It really underscores this interesting and maybe slightly destabilizing aspect of modern markets.
Yeah.
The power of lots of individuals acting together, coordinated online.
It makes you wonder if the current rules are really set up to handle that kind of emergent market influence.
That's a key question. His signature strategy, the Iron Condor, as the WSJ explains, it's a complex options bet on the S&P 500 staying within a certain price range.
So when Captain Condor shares his trades, his followers, over 1,000 of them, often jump in too, amplifying the position.
Exactly, and some of their combined trades have apparently been large enough to actually move the market, at least temporarily. It's a bet on low volatility, essentially. You profit if the S&P 500 price stays between two specific higher and two specific lower price points.
It highlights the power of these networked individual investors today. One person's idea, amplified by a community, can suddenly have real market weight.
It's a definite shift. But the WSJ piece also flags the risks. Captain Condor apparently uses a pretty aggressive doubling down approach.
Experts compared it to gambling.
Some did, yeah. And while his community members need at least $26,000 to join in, the potential for big, fast losses is definitely there with options trading like that. Sounds high stakes.
Very. And the journal mentioned Captain Condor himself is thinking about closing the community to new members, maybe because he sees the risks too.
That's what the article suggested, yeah. Fear of potential negative outcomes. It implies even he recognizes the dangers in coordinating such large-scale, complex trades.
Okay, let's quickly touch on a few other key headlines. Bloomberg reported Google's facing a new class action lawsuit over in the UK.
Right. Businesses are alleging Google abused its dominance in online search to overcharge them for digital ads.
And the potential damages are huge. Something like 5 billion pounds?
That's the number being floated, yeah. The suit claims Google basically stifled competition and pushed its own ad services unfairly, leading to inflated costs for UK businesses using their ad services after 2011.
And Google's response.
Bloomberg says Google calls the lawsuit speculative and opportunistic. So, sounds like it'll be a long legal fight. It just adds to the growing pile of legal challenges big tech is facing globally.
Meanwhile, MarketWatch noted gold hit a fresh record high.
Yeah.
Over $3,300 an ounce.
Yep, prices up about 26% this year alone. Driven by all the trade worries, geopolitical uncertainty, investors and central banks are buying it as a safe haven or diversifier.
But there's a twist, right?
There is. That Bank of America survey MarketWatch cited. Fund managers apparently now see long gold as the most crowded trade out there, even more crowded than the Magnificent Seven tech stocks.
Huh. That's often seen as a contrarian signal, isn't it, when everyone's piled into the same trade?
It can be, yeah. It suggests that while gold reflects current anxiety, maybe its upward run could be limited or at least more vulnerable to a pullback if sentiment changes. Something to watch.
Also, Bloomberg gave us a peek into a family succession drama in Singapore. The Flex, Controlling City Developments Ltd, CDL.
Right. Singapore's richest family, major property developer, a public spat between the chairman, the father, and the CEO, his son.
What was it about?
Disagreements over business strategy, apparently, and the influence of an advisor to the chairman. It led to boardroom changes, even a lawsuit, though Bloomberg says there's now a truce.
But the whole thing raised concerns among investors about CDL's performance and governance.
It did. These kinds of internal fights, even in huge established companies, show how disruptions can come from within and shake investor confidence.
Okay, nearly there. Let's look at the bond market quickly. Bloomberg reported U.S. Treasury yields have been choppy.
Yeah, partly due to President Trump's global tariffs impacting even their safe haven appeal. Bond traders are now really waiting for signals from Fed Chair Jerome Powell.
What were they looking for?
Guidance, basically. How's the Fed seeing all this market turmoil? What might it mean for interest rates down the line? Upcoming U.S. retail sales data and a Treasury auction will also be key indicators.
The fact that even treasuries are volatile shows how much uncertainty these trade issues are causing, doesn't it?
It really does. Powell's comments will be crucial for providing some clarity on the Fed's thinking and potential policy responses.
And finally, MarketWatch looked at the recent rise in real Treasury yields adjusted for inflation.
Right. While the headline 10-year yield has ticked up, causing some worry about tariff impacts, research from DataTrek, cited by MarketWatch, points out that these real yields haven't hit recent highs yet.
Suggesting maybe no immediate crisis of confidence in U.S. debt.
That's DataTrek's take, yeah. The inflation-adjusted yield gives a clearer picture of underlying confidence and borrowing costs. That said, they also warn that if real yields stay above 2%, it could start to slow economic growth.
So it's not a crisis signal yet, but definitely something to keep monitoring closely as things evolve.
Exactly. That distinction between nominal and real yields is important.
Okay. So wrapping up, it's clear the financial world is navigating, well, a really complex web right now. You've got the semiconductor sector feeling the pinch from trade tensions.
Which connects to broader economic shifts in both China and the U.S.
Plus these interesting side stories, like the options market movers and boardroom dramas.
And that thread of tariff uncertainty seems to run through almost everything, hitting supply chains, oil production, investor mood.
It's definitely a time that demands careful watching and a nuanced view of all the factors at play. We really hope this deep dive has given you, our listeners, a clear perspective on these critical headlines and what they might mean.
And hopefully sparked some thoughts. We encourage you to dig deeper into the stories that particularly caught your attention.
Absolutely. We'll see you all tomorrow morning with new headlines from major financial magazines.